Hello everyone, Stefan Moritz here with Advisory, and today we're going to be talking about the new tax law updates to the One Big Beautiful Bill Act. So let's jump into it here. There's not a whole lot of huge changes that are going on, but we'll address them point by point. In a nutshell, the One Big Beautiful Bill Act cements or seals in the Tax Cuts and Jobs Act of 2017 and keeps all of those changes that were set to expire at the end of 2025 to be now going on to be a permanent part of the tax law. So what that means in short is things like the qualified business income deduction, the 20% from qualified businesses, is now sealed into law. The deductions for mortgage interest at the first $750,000 of mortgage is now permanently in there. Standard deductions are permanently higher, and the personal exemption seems to be gone like the way of the dodo bird. One major change, though, to itemized deductions is now the increased state and local tax deductions. So previously, whether you were single or married filing jointly, you would take all the state income taxes you're paying, or if there are no state income taxes in your state, then it would be sales taxes. You would also add in property taxes and personal property taxes, things like DMV registration for your vehicle. Sum all those up and compare it to $10,000, whichever one's lower would be the deduction that you would take. This severely limited deductions for folks like us in California, where we have very high property taxes based on high property values, as well as high state income taxes. In fact, some of the highest in the entire country. Now, the limit used to be $10,000. It's now $20,000 for a single or married filing separately person, or married filing jointly would be at $40,000. These deductions are going to phase out after $500,000 of adjusted gross income, and so it's a helpful tool, but it's not going to dramatically change things for the top tax earners. Let's talk about some of the priorities that President Trump outlined, and those priorities that gained a lot of traction in the news recently around tips, overtime, and the Trump accounts. Let's first talk about tips. If you are a qualified tip worker, in other words, a worker that normally would receive tips like waiters and so forth, then if you're making up to $150,000 of adjusted gross income for single folks or $300,000 for married filing jointly, then a $25,000 deduction is available for you on the other side of that tax return, assuming that you're earning tip income in your profession. Similarly, if you're earning overtime wages, the same AGI limits apply of $150,000 for single, $300,000 for married filing jointly, and again, another $25,000 deduction is available to you for overtime pay that you receive. In addition to that, there is also this new concept of a Trump account. And so for any babies born after January 1st of 2025, you can make a contribution to an account in the name of your child of up to $5,000 per year. And these accounts can be then withdrawn when the baby turns 18 years old, so no longer a baby. And those amounts can be used for various things like setting up a business or paying for school. When the money is withdrawn, the gains would be taxed at long-term capital gains, but in those intervening years, so let's talk about the first 18 years of those accounts, then there would be no taxable impact at all whatsoever. So you can consistently trade and buy stocks and so on and so forth within the account, and there won't be any tax impact. This works similarly to an IRA or a 529 plan. It's more akin to a 529 plan, to be honest with you. But this is something that's available to new babies. So anyone born before January 1st, 2025 would not be eligible to set up these new Trump accounts. Let's talk about the most important change in the tax law, which is the revival of the bonus depreciation rule. If you can recall, bonus depreciation was available up through tax year 2022 at a rate of 100% for qualified improvement property. Afterwards, it started to scale down. And so in 2023, it was 80%. In 2024, it was 60%. And in 2025, it's down to 40%. That has now all changed. We are now permanently at a 100% bonus depreciation regime, which means that for all you real estate investors out there, cost segregation studies are alive and well, and we're gonna be able to see these huge deductions that are generated from engaging in these cost segregation studies. Fantastic outcome. We're very excited for it. Similarly, we also have the revival of the full expense of research expenditures deduction. So what happened usually was before 2021, research and development expenditures were able to be deductible in full instead of capitalized and amortized over a certain period. After 2021, you started to see that those amounts had to be capitalized and amortized. We are now back to a permanent deduction of research and development expenditures. This is very helpful for our folks who are engaging in tech work and any sort of research, they're able to get those immediate expense deductions today versus having to wait over 2 to 3 years in order to receive them. Fantastic outcome once again. So I should also mention that it is retroactive. And so if you were forced to be on a capitalize and depreciation schedule for your research and development costs, you can now go back and amend the returns, or you can do a change in accounting methods and space it out over 1 or 2 years based on an election that you'd like to take. You'd have to talk with your tax person about what would be the best way to take those deductions, but it's, again, a very exciting thing. We have a lot of folks who are working in tech who like to use that money to invest in real estate as a diversification strategy, and any angle we can have to save taxes today is a fantastic outcome. Now, for our international folks, there are a few tweaks related to the rules around GILTI. Now, GILTI sounds like a funny name here. It's like you're guilty of something, but it used to stand for Global Intangible Low Tax Income. That definition has been struck out. It is now called CFC income because the concept of intangible has also been removed. Previously, international taxpayers would get a reduction of their taxable income at a rate of 10% of their qualified business asset investment, and then you would take into consideration the Section 250 reduction, which used to be 50%. It then scaled down to 37.5% of the corporate income, and so now it's back up to 40%. So there isn't this 10% return on investment concept that would have been tax-free. Instead, now it's just straight up 40% on all the income that you earn overseas. But the foreign tax credit that relates to your CFC income is now included at a rate of 90%, whereas it used to be 80%. So these are little tweaks or interesting changes. Overall, it forces the international taxpayers to pay just a little bit more of their CFC income. However, it's still a very good tax strategy, and it's something we highly encourage here at Advisor.e, especially as you start to look at countries that have very low corporate income tax rates, such as the UAE. Some other real estate relevant concepts are things like the low-income housing tax credit are now made permanent, as well as a new markets tax credit, and also opportunity zones are kind of a permanent thing here. Before, we used to consider them to be a temporary concept. Now they continue to be a fantastic tax saving strategy if you're interested in developing in areas that are considered to be opportunity zones. Lastly, let's talk about all the cool solar and EV credits that used to be around are now gone, unfortunately. And so after September 30, 2025, you're going to start to see a lot of these credits phase out and eventually be eliminated. That would include the installation of solar panels and batteries in your home, the acquisition of electric vehicles, and in addition to that, other qualified energy property, things like efficient water heaters, heat pumps, those sort of things that offered a little bit of credits during the Inflation Reduction Act are now pretty much going to be completely eliminated as the current administration has shifted priorities away from renewables and green energy towards other areas of focus. So I hope this helps you understand what the new One Big Beautiful Bill Act has done. It's not a lot of huge changes that have kind of come down the pipe. It's more or less more of the same. However, we're back in the 100% bonus depreciation realm. Research and development expenditures are fully expendable, and some tweaks around international tax law more or less keep things in line with how things used to be. I don't foresee this tax bill dramatically impacting the changes on your tax planning over 2025 and 2026, but it's important to know them as you consider to plan for the future. Thanks so much for watching, and look forward to seeing you in our next video. So make sure to like and subscribe to our channel for all the content related to real estate investment and tax saving strategies.